Let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, great to catch up with you again. So the focus, of course, on inflation in the States. Headline, perhaps higher than expected, but the focus was really on the underlying measure.
Yeah, and it came in lower than expected and dropped for the first time in about 6 months. So it was really quite a surprise. I don't think the markets were really positioned for a positive shock. Everyone was concerned that maybe we'd see a 3.3% figure, which would be in line with the month prior, and that potentially the risk was sort of skewed to the upside given the recent data flow. And again, this ongoing concern that inflation is sticky and maybe re-accelerating. So the fact that we got this drop was a real relief to the market. It's almost a breakthrough of sorts. It keeps the door ajar for continued rate cuts eventually from the US Federal Reserve this year, and the market started to flirt with the idea that maybe there'd be 2 cuts from the Fed this year, as the Fed obviously outlined in its last summary of economic projections. But it was just a total relief rally, and investors really bought stocks and bonds hand over fist, and really it's kind of reversed or at least changed the narrative just a little bit, and maybe put Wall Street's bull market back on solid footing.
Yeah, adding to that risk-on sentiment, we've got that ceasefire deal happening between Isreal and Hamas, and also corporate earnings from the big banks in the States.
Yeah, and the bank results were solid, and I mean that augurs reasonably well for our local banks, which have kind of traded not based on their own fundamentals or even the fundamentals of the Australian economy, but certainly the lead that we've been getting from Wall Street. And we have to say that over the last week or so, there has been actually some strength coming through the financials, despite generally speaking, some subdued price action in US indices, mostly generated by sort of rate-sensitive tech. So that was one positive development. The other, of course, was that kind of boost to market sentiment from the fact that we do have this ceasefire deal now between Israel and Hamas. That was telegraphed somewhat around 24 hours ago, and that's when we saw the first move in oil prices to the downside, reflecting the possibility that there would be something of a deal. Oil prices actually didn't really move that much on the news. In fact, significantly higher for the day, but that was more based on the supply and demand dynamics coming through in some inventory data. But the overall sense is that this is a good thing for the markets. Again, there was a limited move, which sort of suggests that maybe that conflict, probably because of Israel's potency and sort of nullifying a lot of its sort of adversaries in the region, wasn't that much of a risk to global markets. But again, it is another good news story on a day that had a lot of good news and sort of fed this rebound in US equities, which is likely to flow through, of course, into Asian markets, the ASX 200 today.
Yeah, just before we get on to what we're seeing locally, also interestingly too, got an inflation read out of the UK, and at least one policy member there saying they're on track for 150 basis points of cuts this year.
Yeah, I mean, this was probably, at least in terms of its importance to a domestic economy, more significant than the US inflation data. And that's because effectively we were getting these kind of renewed worries of a trust-like meltdown in financial markets, and this kind of sell-off that we did see in simultaneously the FTSE, gilts along with the pound, made markets very, very nervous that we were seeing a potential crisis of confidence in the government and a crisis in confidence in UK assets. So the fact that we did get this downside surprise in UK inflation data as well, speaks to the fact that maybe the kind of moderation that we saw in the US CPI number is consistent for what's happening across the globe and this sort of disinflationary impulse. And then it also takes the pressure off the Bank of England and also the UK government to sort of have to stabilise the situation in UK markets. And of course, this kind of risk that everyone was worried about, that the UK was heading for sort of stagflationary conditions. It doesn't completely alleviate the problems. There are these concerns that, basically because of, low growth, sticky inflation, poor productivity, fiscal settings, which will more or less see a debt load increase faster than the kind of rate of nominal growth in the UK economy, that things need to change significantly in a structural basis to sort of improve the outlook for UK's public finances, the UK economy, but it does give a little bit more breathing room for the government to be able to do that, to get its house in order, and as a result too, it also eliminates one kind of systemic risk, if you will, from global financial markets, which again was another reason for markets feeling a little bit more bullish last night.
So, Kyle, to the local market, then, as you say there, that we're expecting local market to rally as well, following global peers. But I guess we're also looking ahead to next month's interest rate decision from the RBA. And today we do get a key data read on labour.
Yeah, and it will be an interesting one because, first of all, consistently last year, the jobs figures surprised to the upside, and we've actually got a fairly moderate prediction from economists on aggregate as to what we can expect from the labour force figures for December, an increase of about 15,000 jobs for the month and a slight uplift in the unemployment rate to 4%. I mean, there's sort of a relative and then also an absolute way of looking at these things. From a relative perspective, if we do get a bit of easing in the labour market, a lift in the unemployment rate, clearly that's going to add to the case that the RBA may be able to lower interest rates next month, because one of the few things, despite weak growth settings, despite weak households' balance sheets, or I should say household consumption, is that the labour market has been surprisingly strong and businesses have been hiring for the better part of obviously a couple of years, but certainly last year as well. If we see that the situation is softening there, it gives the RBA a little bit more wriggle room. However, it has to be put in the context, and this is where you sort of talk about absolute levels a little bit more, that at 4%, although the estimate could be wrong, the RBA's estimate for the notional full employment is around 4.5%. So still the labour market is well and truly above capacity, well and truly at full employment and beyond. So, there is that notion that perhaps the jobs data, no matter what happens, won't really give the RBA a clear impetus, at least from the labour side of its mandate, to be able to cut interest rates. But certainly if it's a little bit softer than expected, shows some sort of weaker demand conditions for labour in December, it means that we can then turn to that quarterly inflation read at the end of the month, which will be the decisive factor for whether the RBA cuts or not in February, and effectively put the labour situation to one side and focus fully on that. So it could be an interesting one. At the moment, the markets are pricing in around 60% of a chance of a cut in February. I suspect that will probably lift today just by sympathy of what's happened in the US inflation data last night. But again, softer than expected, may raise those odds, and then we'll turn our focus to that inflation figure as to whether we get effectively a green light in the data for an RBA rate cut or not.